This is Nightly Business Report with Tyler Matheson and Susie Guerin. Brought to you in part by
TheStreet.com, interactive financial multimedia tools for an ever-changing financial world. Our dividend stock advisor guides and helps generate income during a period of low interest rates. We are TheStreet.com.
Big moves. Microsoft and Amazon shares taking off after the bell today, capping the busiest day of earnings this season. What's the most important takeaway for investors from these two tech titans?
Zero profits, big returns. But when it comes to quarterly reports, there are some companies that don't earn a dime, yet their stocks are soaring. We'll explain why and name names.
And the blame game. Who's really at fault for the botched rollout of the new health exchanges? Developers pointed fingers on Capitol Hill today. And tonight, we'll ask a former White House healthcare advisor if the problems can be fixed. We have all that and more tonight on Nightly Business Report for Thursday, October 24th.
Good evening, everybody, and welcome. Today was the biggest day of earnings reports we'll get. By and large, the numbers were pretty good, and the market took notice, moving higher. Late this afternoon, two of the biggest tech companies of them all, Microsoft and Amazon.com. And here again, investors mostly liked what they heard, pushing stocks higher after hours. First up, Microsoft, the world's biggest software maker, beating the street estimates for both earnings and revenue. Profits up 17% last quarter to more than $5 billion. That comes out to 62 cents a share, excluding certain items, far more than the 54 cents Wall Street was looking for. And sales topped $18.5 billion. That was also more than forecast. Seema Modi joins us now with more on Microsoft's strong results. Seema, what's the one big takeaway from these numbers?
So, Tyler, the major takeaway here when you take a look at Microsoft's earnings report is that the company is finding ways to offset slowing PC sales. That's been the big concern of late. Its devices business, which includes the Xbox, that business continues to grow. So improving consumer demand in this space, as well as in its enterprise and cloud computing business, that is what helped Microsoft deliver that solid beat.
All right, we're going to come back to you in just a moment, so sit tight. Now on to Amazon.com, where the world's biggest online retailer saw its revenue rise, but it reported another net loss for the third time this year, 9 cents a share, excluding certain items, just as analysts predicted. But revenue came in higher than expected, topping $17 billion for the quarter, and shares took off in after-hours trading. So, Seema, back to you again. What is it that investors were seeing in these numbers today?
Well, I think when you just take a look at that chart, that tells you the story right there. Wall Street doesn't seem to care that Amazon is not profitable as long as it continues to deliver strong revenue growth. Keep in mind, Amazon is in expansion mode, specifically overseas. That trend doesn't seem to be stopping anytime soon, especially when traders continue to bid up the stock.
And this, of course, is not the first time in Amazon's history that investors haven't seemed to care about no profits.
Absolutely.
All right, Seema, thank you very much. Well, when you look at Amazon's performance this year, the stock has skyrocketed 30%. It's up 455% in the past decade, but you'd never know it from looking at Amazon's bottom line. In fact, there are a number of big-name companies that have seen a big run-up in their shares without making any real money. Dominic Chu explains.
As a company, you don't really need to make money for your stock to go higher. The investing world is littered with examples of companies who fail to generate profits, yet still manage to show healthy stock price appreciation. Take consumer electronics giant Best Buy. It's in the midst of a turnaround effort by CEO Hubert Joly. Over the course of the past year, shares have gained over 150%, which translates into an added $9 billion in stock market value. During that same time frame, the company has posted a net loss of $234 million. Then there's online discount brokerage company E-Trade Financial. You know, the company with those commercials of that cute baby who talks about stock trading.
The economy's been a little rough.
E-Trade shares have close to doubled over the last 12 months, adding nearly $2.5 billion in market value. Yet the company posted a loss of $234 million during that time. And let's cap it off with a look at a brand name in computers and technology. Hewlett-Packard, HP. Former eBay CEO Meg Whitman is now running the show at HP. Over the last year, the stock has soared some 70%, which has added over $18 billion in market value for shareholders. Meanwhile, HP as a company has lost around $3 billion during that time. So, why do companies who lose money keep getting rewarded by shareholders? The answer lies in future expectations.
Stocks basically exist to discount the present value of what future earnings will be. So when you see stocks that are rising without profits at the moment, investors are voting that profits will be higher in the future.
So don't be fooled. When it comes to investing, don't discount a stock just because the company doesn't make money. If you think it will make money in the future, then that might be a good reason to buy. For Nightly Business Report, I'm Dominic Chu.
Now, before the opening bell today on Wall Street, investors sifted through a new round of stronger than expected earnings from companies like 3M, Ford, and Southwest Airlines. And they liked what they saw and shrugged off today's economic report. Jobless claims fell by only 12,000 last week. That was less than expected. The Dow rose 95 points, the Nasdaq was up 21, and the S&P added 5 points.
Well, with the market in positive territory and continuing its climb higher, is there ever a good time to start selling some stocks in your portfolio? And is this one of those times? We asked Scott Wren. He's senior equity strategist at Wells Fargo Advisors. Scott, good to have you back. You know, the market has been doing very well this year. I know you think, and many people think, that it's sort of close to fairly valued or fully valued, not way ahead. So I'm not asking that question, but there are certainly a lot of stocks in the market today that have had big run-ups. When do you start taking profits?
Well, Tyler, you're right. Our target for the S&P 500 is 1650 to 1700 for year end. We're trading a little bit higher than that. I don't think we're going to see a lot of follow through from here. And you're right. There's a number of stocks, a lot of stocks that really have seen some valuations run up. And for us, you know, retail investors pay the bills here at Wells Fargo Advisors. And so you mentioned, you know, Dominic mentioned, you know, stocks that don't really make money but have, you know, big market caps and things like that. That's fine. For some people. You know, you want to have maybe a few of those in your portfolio. You don't want to have 50% of your portfolio in stocks that don't make money, in my opinion. So I think what we want our clients to do is largely be positioned in S&P 500 type stocks, quality stocks, dividend-paying stocks that you can build wealth in over time. So now, given the fact that we're above what I would consider a fair value valuation, we're not a lot above those. But for some people, particularly those that want to be a little lighter on their feet, it might not be bad to take a little bit of money off the table. I'm looking for more volatility. I think we're going to have some opportunities to buy stocks at lower levels. But really, for most retail investors, think about it. You know, a 5%, 8%, 10% pullback, retail investors can't play that tight of a market. Yeah. That's not enough for them to get in and out.
We talk a lot, Scott, I know, on business television generally and in the personal finance magazines about what to buy and when to buy and buy on this pullback. But I look at a guy like Carl Icahn, who earlier this week sold half his very rich stake in
that worked out pretty well, didn't it?
It worked out pretty well. But what he was doing there was executing on a sell discipline that he had. How important is it for an investor, the moment they buy a stock, to know when they're going to sell it?
Well, ideally, you'd like to have an entry point and an exit point, and that's maybe a little bit more of a trade. But investors have to think to themselves, I have an idea in my mind, whether it's through buying somebody's research or using our analysts here, that what is fair value? If momentum takes it above fair value, you should start looking for ways to peel off a little bit of the money that you have, of the profit you've had. 20% of the stock, 50% of the stock. But if it's a good quality stock that you think has room to run in the long term, you don't want to completely cut out of that stock, because who knows if you'll ever get back into it.
Which is kind of what Icahn did. He sold half his stake. He said earlier today in an interview, he said, I've made 5 times my money in that stock. And when I do that, I want to start taking some cash off the table. But here he's letting, I guess you would say, his profits run because he still believes in the company.
Nobody's going to fault you, and investors should not feel bad about taking some money off the table. You still have some of that position left. You still benefit if there's more.
You never
upside.
lose when you take a profit, do you, Scott? Now, let me ask you the converse question. At what point do you decide to sell a company that you've bought that is losing? Should you go in and say, okay, the minute this thing goes down 20%, I'm out of here?
Yeah, I think really when you have a gain in a stock, or even when you buy a stock, you should have at least some sort of a mental stop. You have to say, well, if it's more of a trade, I think I can make $10 on this stock. Well, for me, I like a ratio of about 3 to 1. If I think I'm going to make $10 on a stock, I really don't want to lose more than about $3 or $4, something like that. So, investors, they have a big problem.
Helpful.
Retail investors, they hang on to losers way too long. And you have to be in the right stock at the right time, at the right part of the cycle. That's all hard to do. But you need to have mentally in your mind when you're going to get out of their stock.
Tell me
You're
about
not
it.
going
I
to
know
ride
it
that
from
thing
my
down
own personal
80%.
experience. You just sit there and you go,
Yeah, we all do.
I know this stock's
We all
coming
do.
back. I love it. Scott, we
Right.
got to leave it
Yeah.
there. Thanks very much for your help tonight. Scott Wren,
All right,
Senior
Tyler, have a
Equity
good evening.
Strategist at Wells Fargo. You too.
And we've got some big news tonight about the planned initial public stock offering of Twitter. In regulatory filings out today, Twitter disclosed that it would price the stock in a range of $17 to $20 apiece. It plans to sell 70 million shares, putting the total valuation of the company at about $11 billion.
Well, the big story in Washington today, healthcare and the $500 million website that doesn't work right. The main contractors for the government's healthcare.gov marketplace got grilled by lawmakers for their role in the glitches, errors, and long wait times that have plagued the site from the start. Boother Coombs was in Washington for the contentious hearing and filed this report.
There was one thing all the contractors agreed on today on Capitol Hill. Whatever went wrong, it wasn't their fault. CGI, which built the Federally Facilitated Marketplace, or FFM.
The FFM passed 8 required technical reviews before going live on October 1.
QSSI, which provided enrollment software, said it raised red flags about parts of the system that didn't work.
Our work, the Data Services Hub, was tested well, tested adequately. We tested every piece of code we received timely. We returned a full report of any bugs we found.
The problem, they say, is that the system's pieces don't work well together. And it was health officials from CMS, the Centers for Medicare and Medicaid, who oversaw the project end to end and who decided to go live despite red flags raised by testing.
CMS had the ultimate decision for a live or go or no-go decision, not CGI.
While there were partisan moments, there was plenty of frustration on both sides of the aisle with the seeming lack of accountability.
Are you saying that you didn't test, that the tests worked very well, both inside and out, or that you turned it all over to CMS? Anybody want to answer?
And we had independent contractors testing our system.
Do you think it's right that 99% of the people that try to go through the system get rejected, can't even complete the application? Is that a system that you're proud of?
Sir, this is a system that we are working every day to make improvements.
None of the witnesses today could say for sure when the problems will all be resolved. CGI lead contractor estimates it could take another 2 months. The health department won't commit to a timetable, but you can be sure members of Congress will put that question to Health Secretary Kathleen Sebelius when she testifies before the House next week. Bertha Coombs, Nightly Business Report, Washington.
Our next guest has some suggestions on how to fix those problems. He's Dr. Zeke Emanuel, the former healthcare advisor to President Obama. He's now vice provost at the University of Pennsylvania. I talked with him a short while ago, and he began by talking about what went wrong with the government's program from the get-go.
The first thing is that the regulations and guidance necessary to specify what the sites would look like so the contractors could build them came in late. There wasn't a CEO with a lot of managerial experience who's been involved in the health insurance industry, been involved in enough IT to really understand the system running it. Instead, the people who run Medicare, who know how to pay bills and know how to issue regulations, but have never built an e-commerce site, were entrusted to build this, which didn't make sense, and to integrate all the different components. I'd say also the toxic atmosphere in Washington, with one party trying to defund it and constant battles and not everyone trying to work together to make it work, didn't help anything. And then we've also found out this week that it wasn't tested from end to end. So someone started the process and worked their way all the way through in a testing phase beforehand, which is sort of normally done wasn't done.
So, Dr. Emanuel, what's the solution here? It's a mess. I mean, what do you think are the key things that the Obama administration has to do to fix the problem?
The first and most important thing is to get a CEO. They've got a temporary CEO in Jeff Zients, who is a proven manager. I've worked with him. He's a very good person, a very good people person. He also has actually been a consultant to the healthcare industry, so he understands healthcare. He's going to be in there, but he's temporary because he has a full-time job to go to in January at the White House, and they need a permanent person who has the skills I mentioned, that good manager, knows something about the health insurance industry, knows something about e-commerce and IT, and can put up a site. They need someone who will see the site through for the next couple of years at least.
So you're pretty familiar with the thinking in the White House and in the Obama administration. After all, you did advise President Obama early on the health care reform. At what point do they come to the thinking and saying, you know, we're not ready. This is going to take longer than we think, and we're going to be better off if we postpone the enrollment? What do you think? When are they going to get to that point?
That depends upon the IT solutions that you can put in place over the next 5 weeks. And as I understand the problem from people who are close to it, this is not rocket science. This is about blocking and tackling and doing basic things correctly. And the question is, if we can get the website up and running in 5 weeks, I don't think they're going to have to postpone enrollment and postpone the mandate, and I don't think that would be necessary. Now, if it turns out that there are much bigger problems and it cannot operate at a reasonably good level by Thanksgiving, that would force you into a different decision.
One of the key issues here is that the success of Obamacare depends on healthy 20 and 30-year-olds to sign up for insurance. And if they feel that there are too many hassles and they give up, doesn't that undermine the program, whether it's for an insurance company, for the hospitals, pretty much everybody? Isn't that a risk that the Obama administration is facing here by continuing this program as is?
As you correctly point out, getting people across the age spectrum, but in particular younger people who may be not clear what the actual advantage of getting the health insurance is for them, enrolled, is very important. And so making sure it works well enough so that they can sail through the process in 20 or 30 minutes is very important. And I do think that's got to be the goal. But again, from what I've heard, that can be achieved. And we know that other websites around, as I mentioned, Colorado, Connecticut, California, the District of Columbia, Kentucky, have been able to do that. So I think this is a solvable problem. It's not an insoluble problem.
And Dr. Emanuel also had some advice for the Obama administration. It should be totally transparent with the American people, telling them what the problems are, how they plan to solve them, and what's the timeline.
Still ahead, one hedge fund manager makes the case for Apple at $1,250 a share, more than doubling its current price in 3 years. Details next. As NBR reported yesterday, activist billionaire investor Carl Icahn is publicly pressing Apple's CEO Tim Cook to launch a massive $150 billion stock buyback plan. In a letter, Icahn, who now owns 4.7 million shares of the company, says the buyback would take so much stock out of circulation that it would push the share value from the current price of about $532 to a staggering $1,250 within 3 years, given the forecasted profit growth. Also, Icahn said that if a stock buyback plan isn't implemented, he will, quote, test the waters on a proxy fight against Apple's board of directors.
If Apple goes for a $150 billion stock buyback, it would be the biggest one ever offered by an American public company. That would be more than Apple's own $50 billion program from earlier this year, and equaling the next four combined, which are all Microsoft buybacks.
Well, some big names reported earnings today, and we begin Market Focus with positive results from Dow component 3M, a maker of Post-it notes and Scotch tape. Reported profits had beat estimates by 3 cents a share. The conglomerate reported improved results in a number of its businesses, from industrial adhesives to materials used in cars and airplanes. Shares up fractionally today, $123.49. They are up 33% so far this year. An improvement in sales overseas helped drive Ford's bottom line. The country's second biggest car maker cited strength in North America and a smaller operating loss in Europe. Ford also had an upbeat outlook, raising its full-year guidance. That helped drive shares up more than 1% to $17.76, a patriotic price. Dow Chemical, the largest U.S. chemical maker, reported both disappointing earnings and revenue. The company blamed weak results on its performance materials unit, which Dow is looking to sell and which is exposed to commodity price swings. But the CEO was quick to focus on its plastics unit, a business growing as the economy recovers.
Another reason price increases stick is supply-demand gets tighter. Improving economy means demand goes up. And as just reported by the Ford result, automotive is going up, housing and construction is going up. So there's some markets that are tightening that enable price and value share to occur. And that's really the packaging plastics business.
But gains in plastics were not enough to bring the stock up. Shares were down 1% today to $40.62.
Xerox also down today after issuing a disappointing forecast. The company cut back its outlook for the year because of restructuring charges in its outsourcing business and higher pension settlement costs. Revenues also came in lighter than expected, but earnings beat estimates by a penny. But investors focused on that outlook, sending the stock down 10.5% to $9.61. Cost-cutting and improved ticket sales helped Royal Caribbean beat Wall Street's earnings expectations. The world's second-largest cruise operator also raised its outlook, saying demand is improving next year thanks to higher bookings in most markets, including Europe, Asia, and Alaska. Shares sailed higher, up 6.5% to $42.35. And PulteGroup, the #2 U.S. home builder, reported a rise in third-quarter earnings, helped by an increase in selling prices. As for the recent rise in mortgage rates and the overall slowdown in new home orders, Pulte's CEO said he believes it will be short-lived. Shares shot up 7% to $17.85, making it the best-performing stock on the S&P today.
And Susie, if you'd like to get a full list of all of the day's earnings, go to our website, nbr.com.
And coming up, we introduce you to one of Wall Street's most feared regulators. He's putting the heat on the banks and changing the way some big institutions do business.
The Federal Reserve wants big banks to have more cash available than they do right now. The nation's central bank is proposing that large U.S. banks keep enough cash, treasury bonds, and other so-called liquid assets on hand to survive a severe economic downturn like the financial crisis of 2008.
Now, one of those banks, Bank of America, is laying off a lot of workers in its mortgage division. It's already told 1,200 mortgage processors that they were losing their jobs. Now, the Wall Street Journal reports that as many as 3,000 more workers, these are ones who work in the troubled home loans division, may also get pink slips.
Well, not many people know Tom Curry, whose title is Comptroller of the Currency, but big Wall Street banks sure do. He's one of the bank's most feared and important regulators. He's responsible for levying billions in fines just this year and keeping those banks in line. Kayla Tausche sat down with the comptroller and has more.
Wall Street's got a new sheriff in town. No matter that the office of the Comptroller of the Currency has been around for 150 years, Tom Curry, who took the helm of the agency a year ago, is new blood at a place once criticized for being too cozy with the banks. He's out to prove that's wrong. And he's making the banks pay. In 2013, the OCC has put out 152 enforcement actions and collected $500 million in fines, on the rise from previous years. Its highest profile target, the biggest bank in the country by assets, J.P. Morgan Chase. Anti-money laundering efforts, marketing of identity theft products, and a whopping $300 million fine for faulty disclosures in its London whale trading loss, just a few of the issues where the OCC's taken aim. It's got an eye on management, too, forcing CEO Jamie Dimon to cede his role as chairman of the bank's subsidiary. Here's what Curry said about that move generally.
Management, particularly the board of directors, needs to be a credible challenge to operating management. Individual institutions will be prodded to take a critical look at their structure.
Corporate governance, just one of the areas where Curry's stepping up his standards for banks.
We think the bar should not be set at satisfactory in critical areas such as risk management, audit, and corporate governance.
Stricter formal guidelines for the banks are expected later this year. Just today came a new proposal with the Fed and FDIC that yet again increases the capital banks must hold for a rainy day. Now Washington wants banks to keep at least 30 days of liquidity on hand in case another credit crunch comes along.
In a banking crisis, it was important to demonstrate that both the level and the quality of the capital is there before a crisis emerges.
As regulators like the OCC's Curry look inward 5 years after the financial crisis, prevention is the priority. For Nightly Business Report, I'm Kayla Tausche.
And Kayla's right. That is the prevention. Nobody wants another financial crisis. And we were just talking about how the banks feel they have too many regulations and investors feel like they don't have enough.
That's right. The investors feel that they were burned, or shareholders feel that they were burned during the crisis, of course.
Well, we're going to have to leave it there. That's Nightly Business Report for tonight. I'm Susie Garrett. Thanks so much for watching us.
And thanks from me as well. I'm Tyler Matheson. Have a great evening, everybody. We'll hope to see you back here tomorrow night.
Nightly Business Report has been brought to you by
TheStreet.com, interactive financial multimedia tools for an ever-changing financial world. Our dividend stock advisor guides and helps generate income during a period of low interest rates. We are TheStreet.com.
I'm Susie Garrett with a Nightly Business Report news brief. Strong earnings from two big tech companies after the market closed, Microsoft and Amazon. Investors liked what they heard, and the stocks took off in after-hours trading. Microsoft profits surged 17%, and revenues rose at Amazon.com, even though it lost money last quarter. On Wall Street, stocks moved higher on a round of stronger-than-expected earnings before the market opened from companies like 3M, Ford, Southwest Airlines, and more. The Dow rose 95 points, the Nasdaq was up 21, and the S&P added 5 points. And when Twitter goes public in November, it plans to price the stock in a range of $17 to $20 apiece, putting the total valuation of the company at about $11 billion. Be sure to tune into Nightly Business Report right here on your public television station.